Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Judith Mackenzie, partner at Downing, to talk about the Downing AIM Estate Planning Service. Hello Judith, welcome to the studio. Good to see you again. I wonder if you could start by telling us about Downing Fund Managers and your own experience.
Yes, so Downing Fund Managers are part of Downing LLP, been around for over 35 years I think, and we have about 1.7 billion under management, and I started the Downing Fund Managers side of the business about 13 years ago now, and we're a boutique fund management house within a larger fund management house, and we really specialise in investing in focused portfolios. And our heritage Downing-wide is in smaller companies, and that really is where I started out as well. So I've been investing in UK smaller companies now for over 27 years, quite a long time. I cut my teeth in both private and public companies. I was with Aberdeen Asset for a number of years, and we did a buyout of the Electra smaller companies assets as well before I joined Downing. So really have been in this sector pretty much all of my career. And on the AIM Estate Planning Service, we have a co-fund manager, Nick Hawthorne, who's also got a mix of private and public experience, and he's been with us now for about 7 years.
And so what does the AIM IHT service aim to do for investors?
Well, obviously you get BPR reliefs on AIM companies after you've held them for 2 years, but we're trying to take a bit more of a slightly different approach to maybe some of the mainstream fund managers. We're quite careful in the way that we grow our assets, and that means that we can invest in companies under £500 million market cap. Typically where other fund managers are not hunting, we're investing in between 25 and 40 companies, and I would say that we've got quite a defensive, slightly value orientated style, and we're very hands-on with our investments.
And there's quite an interesting sort of downside protection element to the offer as well, isn't there?
Yeah, particularly good in this kind of market. I'm fortunate to say that we've not had to use it in the past with our investors over the last 12 years. But what we have is we've got downside protection, which basically, in the event of death for anybody under the age of 90, if they have lost between 0 and 20% of their investment, that's covered by a group-wide insurance policy. So there's no crazy health checks or anything like that. That's a group-wide policy. So that's quite a nice thing to have in this volatile market.
And there's no additional cost to that?
No additional cost.
Just comes with the service?
Yeah.
And so what types of companies are you looking to back within the portfolio?
I would say reassuringly boring. They are companies that have got the characteristics of cash flow, cash generation, a good return on invested capital, with cash in the balance sheet. So, and typically on a 10 times cash flow yield, so not a high risk company at all. Typically companies that have been around for quite a long time. We like management teams with skin in the game and alignment, and if they don't have alignment, then we're prepared to get involved with the companies and actually engage with the boards to put LTIPs and other incentives in place so they are aligned with shareholders.
Are there any types of companies that you look to avoid, or any sectors that you avoid?
Yeah, quite simply stuff that we don't understand. So we've got to be able to understand these companies within 5 minutes, really. We don't want anything that's too blue sky. We don't do things that are crazily unprofitable and are dependent on earnings coming through over the next 10, 12 years, 20 years sometimes in some cases. So we're buying companies on typically between sort of 8 and 12, 15 times. We don't want the heady valuations.
So do you have any recent examples of investments you've made in the portfolio?
Yeah, we've got a business called Ashtead Technology. So Ashtead came out of a much larger PLC a couple of years ago. We don't tend to do IPOs because the DD that you get to do in these companies is too short. So we like to watch them for a while. And Ashtead provides load banks and power banks and hire equipment for some interesting sectors. So not just oil and gas, but very much swayed now towards the renewable sector. So this little company has been on quite a nice little journey, got a great return on invested capital, over 20%. It's cash generative and sitting only at 8 times EV/EBITDA. So we really see that it's got great optionality because it can both hire out the products that they're hiring they have, but they can also then sell some of these load banks depending on different times in the sector. And they're obviously benefiting quite a lot from the whole renewables focus at the moment. So that's one that we added to the portfolio relatively recently.
And what about some of the more mature holdings within the portfolio? Any particular highlights there?
Yeah, we've got a very mature one. It's called Traxys, and they provide software for the transport industry. So anything from as simple as a signal on a train line working, they've got the software there that feeds it back to home base to say that the signal is working or not, to real timetabling. So some pretty complex problems that they solve. And this company came out of Leeds University about 15 years ago, and we first invested in it for these portfolios 12 years ago. We were first investing at about 45p, it's about £9.50 today. So why would you still continue investing in the company when it's gone up so much? And it's because its earnings have gone up about tenfold, and it's become quite a mature company now. They've got great recurring revenue from these contracts with the train operating companies. They've moved into other areas, including highway maintenance. And it really is a nice mature business where, although it's much bigger, we still have the strength of the relationship with the management team as well. So we can engage with them in the same way that we did when they were 10 times smaller. And it's a great growth story, both organic and through acquisition.
Any other examples?
Yeah, another one that's had a bit of a rough time at the moment, but it's a great company and we've been reinvesting in it more recently, is a company called Anpario. And Anpario provides supplements for animal feeds, and that sounds very simple, but actually they're providing natural substances that means that your chicken or your cow or your sheep doesn't need to have antibiotics, and that's a very big regulatory driver as well, and they sell worldwide. So the real diversification for me is that you can sometimes have a tough farming market in the UK, but they're also selling into Chile and other international markets, and that for me is a really good quality business based in the UK that's got worldwide presence. And management team that have been there again for, I think we've been an investor for over 10 years in that business, so we know them well, got net cash in the balance sheet, and probably should be quite acquisitive at some stage. So great regulatory dynamics in that business.
Interesting. And so the AIM market in 2022 has obviously endured a more volatile environment. How is that affecting the portfolio?
Well, we look at long-term track records, and we also look at investing in this type of portfolio for obviously at least 2 years, because you want to get your inheritance tax reliefs. So we actually believe that this is quite a good time to be investing in AIM, especially with that downside protection. So I think if you take a view that you invest just now and you're taking a view over the next 2 to 3, 5 years, then actually you'll win out pretty well. I've given my experience, I have been through many a cycle. I'm not bullish about the next 3 to 6 months, but when we're investing in companies that have got good core earnings, they've got cash in the balance sheet, and they're quite niche, and they've got margins that can be protected, then I don't feel too worried about life over the next 2 to 3 years. And in the short term, we've actually fared slightly better than some of our peers, mainly because we've not been investing in those long-dated cash flows. So we would never invest in something that's on 30 or 40 times earnings in a great growth market, maybe, but we're really much more down in the roots with good companies that are generating cash and have been around for the long term and been through cycles themselves.
So some of those pockets that have seen the most stress, those growth names, that's not your bag. You're more focused on those value-orientated, cash flow-focused businesses.
Yeah, we're not into deep value, and certainly not in this mandate. We don't mind being strategic when we've got a position in a company, but here really we are trying to preserve cash. So we did not shoot the lights out when it came to that crazy growth market on tech stocks over the last 2 or 3 years. But we were just the steady eddies. And if you look at our track record over the last, since we've been doing this, we're up about 119% against the AIM market that's up about 15%.
And so the current environment isn't changing the way you invest at all?
No, we've been doing it for 27 years, not going to change it now.
And so what are you finding most challenging about the current environment?
Being asked as to what's going to happen with this current environment and markets. I think we're all seeking that magic bullet as to what the solution is going to be in markets and how politics are going to affect the UK markets and everything else. I think we know inevitably it's going to be tough for the consumer. It's going to be tough for the next 6-12 months perhaps. We know that we're heading into recession. We've done it before. I think we just stick to our knitting. And the most challenging thing, I think, is not doing our day job and finding the good companies, because we're seeing more and more come into our universe. It's actually shutting out that background noise of maybe thinking and worrying that you might have to change or should change your investment philosophy. That really is the only worry that I have at the moment, that I might get distracted, but I'm going to make sure that doesn't happen.
So no changes on investment philosophy?
No.
But yeah, quite often after you've bought a stock, it comes time when the thesis changes and you have to sell. At what point do you decide to sell a stock, and how do you go about doing that?
I guess we sell for 4 reasons. One, because it will have reached our intrinsic value, so that's probably a good thing, so hopefully it will go up. A lot of what we do is we are almost nurturing some of these companies before they get on the radar of the larger fund managers in our space. So an ideal scenario for us is for a little company like Ashtead to grow up over the next year or so with us. We get the benefit of the earnings progression, and then you might get some multiple expansion when other people start coming in. And so therefore we've seen that happen quite a few times. So we would sell down in that instance. As soon as it's reaching our intrinsic value, we sell down. And then we sell when we're top slicing. So we look at these portfolios on pretty much a daily, but religiously on a 2-weekly basis. So every single portfolio, we'll be trimming it if it's getting to an overweight position. We sell when management lie to us. That's an obvious one. And we sell when the investment case changes. That doesn't tend to happen too much because we've done so much diligence the way in. We tend to be pretty confident on the integrity of that business model, but sometimes management teams can be liars and vagabonds, and then we would be getting straight out of that stock immediately, or we'd change management, change maybe the chair or the board or thereabouts. But in those cases where we are a seller of stock, you've got to be really, really careful in these markets. You can't put a block order on with a trader and then expect them to trade within 25 minutes or even a couple of days. So we're giving instruction to our dealers to see when and how we would trade, and we're looking at what's happening in the market at the same time. So it's quite a careful process. You've got to be quite diligent in these things.
Yeah. And so how risky is investing in AIM? And also the area of AIM that you invest in, is that more or less risky?
Well, risk is associated with the companies that you invest in, and hopefully give you a bit of a flavour that we're not investing blue sky tech stuff. And these are companies that are pretty solid and have been around longer than British Telecom or Glaxo or whatever. So I think you would not buy the AIM index as a whole. You'd be mad to do that. So you've got to be a stock picker in this area. And I do believe that you've got to think about what you're paying up for a company as well. So although it's been a relatively benign period for investing in the AIM over the last 10 years or so, I think that's going to get more difficult, and it's really going to show the real AIM investors who have been around the block. It's going to differentiate those from some of the newer entrants. The other aspect that helps mitigate against the risk is the downside protection that we have. So this covers up to 20% of the net investment should you die under the age of 90. So
finally, to sum up, Judith, for those who want to invest in an AIM IHT service this year, why should they invest in a Downing AIM IHT service?
Well, we've been doing it for quite a while. Nick and myself have got over 36 years combined experience. We've got a good long-term track record, up 119% over the period that we've been investing. You're getting something that is slightly different, so you're not buying the mainstream, so quite a good diversification tool if you were to invest alongside some of the bigger guys. And we've got the downside protection.
Judith Mackenzie of Downing Fund Managers, thank you very much. If you are watching on YouTube, please press like and subscribe to the channel for more.